Good morning and welcome to the second equity webinar for the year. A big thank you to all of you who have taken the time to dial into today's session and for the many questions we received during the registration period. If you do not have an opportunity to submit a question at registration, please do so throughout today's session via the live Q&A chat box. My name is Rochelle Jagger and I'm delighted to be the host of today's discussion, and I'm also joined today by my colleague Chris Wood, who's a Senior Equity Portfolio Manager at Prudential. Welcome, Chris.
Thanks, Rochelle.
We have prepared a pack of slides today to facilitate today's discussion on how we have been delivering consistent outperformance for our clients from both our active stock picking and our portfolio construction. However, before we jump into today's discussion, it's worth highlighting that we are undergoing an exciting change within our business. As you will see up on your screen, our name is changing from Prudential to M&G Investments to closer align with the brand identity of our UK parent company. This is following an announcement in March of this year that M&G in the UK will be increasing their stake in Prudential to that of a majority shareholder. It is also pleasing to note that this has not had a negative impact on our BBBEE rating. In fact, in July of this year, we were awarded an FSC Level 1 rating, which is the highest level that one can achieve. We are truly excited to be part of this global investment brand, and please look out for forthcoming communication around the brand change going forward. So Chris, from a branding perspective, things are changing, but I'm sure that many of our clients would like to know whether this is going to impact the way you manage their money going forward.
Yeah, thanks, Rochelle. I mean, it is going to take some time getting used to the new brand. I'm in my 17th year at Prudential, so there's a long-standing association with Red, Lady Prue. But I think what's most important is just to reassure our investors that this change of corporate brand identity has no impact on the manner in which we manage the portfolios. And there'll be a consistent application of what is a proven long-term track record philosophy and process. As seen on screen, we are primarily valuation based in terms of bottom-up stock picking. We focus on making decisions with investment horizon over long term, typically holding our positions for 3 to 5 years. And then most importantly, everything we do at Prudential, we build portfolios on a risk-conscious basis. It's in our name. It's this prudent approach that we feel has stood us in good stead over the years.
Thanks, Chris. I think that will give clients some comfort that you're applying the same tried and tested philosophy when managing their hard-earned capital. I think a theme that has been playing out in the South African market has been this desire for investors to seek out high conviction types of strategies. And typically these strategies are characterized by highly concentrated bets in single stocks or sectors. Now we know from some of the research we've done is that this can lead to quite volatile outcomes for clients, particularly if held in isolation. What really stands out for me from your portfolio construction is this focus on a risk-conscious approach, particularly with regards to portfolio construction. Does that then mean that you don't have any conviction in sort of the stocks that you hold? And secondly, has this approach delivered performance for clients through time?
Yeah, thanks, Rochelle. It's a good question. I think there's often a misperception when we talk about risk-conscious construction of portfolios. It by no means doesn't mean that we don't take active risk. It's just the fact that we recognize that the future is always uncertain and that our view of the future may actually prove to be wrong. So we limit the size of position that we take, but we go about building a portfolio that is diversified across a broad range of sectors. But what we're most proud of is, I think the best proof of whether this works is the output. And so, what we're seeing on screen here is the track record of the Prudential Equity Unit Trust, and we've got different periods of time, almost since inception, going back 20 years. And the fund has achieved the objective of delivering top quartile performance. In actual fact, if one looks at the green dots on screen, that represents the fund's actual ranking within that top quartile. The fund has actually achieved top decile performance. And if one just draws one's attention to the table below the chart, there we've shown both the absolute return as well as the active returns for each of those periods in question. And just to note, this is on an after fee basis. And so while investors in SA risk assets in the three to 5 years leading up to March of last year, the crisis, had, it had been a disappointing, or, we'd experienced rather lean returns, with SA equities not managing to even beat inflation in the 3 years up to March of 2020. What one can see is that this past 12 months has, we've had exceptional returns from owning South African equities, both on an absolute and a relative basis. And it just goes to show sometimes that it's not about trying to time the market that's important, but it's about taking that long-term view and remaining invested. The worst thing any of our clients could have done last year, or during that crisis, was to have sold their units and effectively taken the sort of option of sitting on cash. And we went to great lengths during a number of webinars last year to highlight what we saw as exceptional valuation opportunity. I think we referred to it as being a 1 in 40-year opportunity to own SA equities. And so therefore today it's very pleasing to be able to demonstrate that some of the decisions that we've taken have delivered this exceptional, call it beta, the sort of underlying market return. And on top of that, we've delivered exceptional outperformance, such that those 3 and 5 year numbers now look actually quite respectable, delivering beating inflation beating returns.
Yeah, Chris, I think it's quite interesting that if you look at the 5 year number, your outperformance is actually half of your absolute performance. So you've delivered almost 10% of performance on an absolute level, but the outperformance has been around 5%. So you've added an immense amount of alpha to the portfolio. I do want to come back to your 1 year number. That's an exceptional result. You've delivered 15% above your benchmark. It looks like quite an outsized number. Can you maybe unpack what's driven that performance? Has it been as a result of one single stock or one single sector performing, or is there a different story there?
Yeah, thanks, Rachel. So as we sort of said in the introduction around the process and philosophy, this prudent approach is that we're not trying to take a sort of a top-down view and embed sort of an expectation for a certain sector or macro variable that will drive the prospective returns. Instead, we seek to pick stocks within sectors and build a diversified portfolio of ideas. And so what's shown on screen here is on the left is the contribution, the positive contribution, the top 10 sectors that have contributed to the last 12 months active returns. And on the right are the top 10 securities. And I think what's pleasing to note here is that there's, yes, certain stocks like Textainer and MTN have delivered more than the others, but it's the fact that we've generated outperformance across a broad range of sectors. And so it wasn't that we got it lucky, so to speak, and sort of had one key driver of performance. Instead, it's been this kind of incremental addition of alpha across the whole market. We often use, and it's quite cliche, we often use the analogy of cricket and sort of waiting for, trying to take the easy singles, accumulate runs that way, and wait for the bad deliveries, and then and be willing to sort of take more risk when the opportunity or odds are in your favor. And last year, as we highlighted in previous webinars, we saw exceptional opportunities. We were spoiled for choice, in actual fact. And I don't think clients quite appreciate the quantum of outperformance. So, you know, to deliver this sort of 15% alpha is certainly not the norm, but it does talk to the degree of pessimism that was priced into some of the South African equities last year, and our willingness to actually step up and take some active risk.
Yeah, I mean, you certainly don't generate those sort of alpha numbers by being inactive. I do want to go back to the previous webinar, which you just referenced a few seconds ago. You know, during this webinar, you put up the list of stocks on the slide. Acknowledging that it is a short time period, can you maybe update us on how these stocks have done? So these were some of your top overweights in your portfolio at March 2021.
Yeah, thanks, Rochelle. So this slide is actually the identical slide that was shown in the webinar on the 1st of March of this year. And it actually represents the 12 largest active positions. And so again, it's been clustered by sort of 4 broad sectors. And one can see that, you know, the portfolio is made up of diverse set of ideas. And it is a short period of time. So this is a 7-month period. As I say, we're typically looking at generating returns on a 3 to 5 year basis. But this has been an exceptional period. So it's worth just highlighting the quantum of or dispersion of returns that were available to investors. And it's very, over this same time period, the market, as measured by CAPSWIX, has delivered sort of 7.5% total return. And so it's very pleasing to be able to sort of demonstrate the stock picking ability of the Prudential team, in that of the 12 stocks on screen, 9 of them have effectively either matched or beaten the market. And one can see that some of them have beaten it by some quite some margin, particularly MTN and Textainer, which are in fact 2 of our largest overweights. But as per my introduction, we acknowledge that we won't always be right, and that our assessment of the future may prove to be wrong. And so, again, it's worth highlighting that 3 of the stocks, 3 of our sort of high conviction ideas as of March this year, have in fact underperformed and delivered negative returns. The most disappointing one being the largest stock on the JSE, the combination Naspers and Process. And why that's disappointing is that this was a year in which we've seen a restructuring of the Naspers process, and what was intended to sort of unlock value has somewhat been overshadowed by the events playing out in China with regulation featuring and leading to their Naspers' largest investment in Tencent underperforming the market. But it was more than, you know, as we've already shown, in aggregate the portfolio has handsomely beaten the peer group, and that's largely thanks to some of, you know, these exceptional returns that were on offer over what, as I say, has been a relatively short period of time.
Yeah, it's been quite a few good stock picks over there, Chris. I do actually want to delve into some of the sectors and perhaps some of the stocks even. I guess one standout stock is MTN. As you mentioned, it's up 94% since the previous webinar. It happens to be one of your top overweights as well. You know, given the performance, the strong performance of the share and the company, you know, can you maybe talk us through how active you're being in this particular stock, and whether you still see some value given the strong outperformance?
Yeah, so MTN has been a stellar performer, and we've allowed it, as it's outperformed, we've allowed the position effectively to get larger in the portfolio, both in an absolute and relative sense. Today, it's actually the second largest holding in the portfolio if one treats Naspers and Proces as a single position. So add the two, Naspers and Proces, together, that they account for roughly 14% of the SA equity portion of the portfolio, and MTN today is around 8% of the portfolio, and is the single largest overweight position. So it remains a very high conviction idea, despite that very strong performance. And I think what one needs to consider with MTN is just where it's come from, and it was held in the portfolios prior to March of last year, but with a dramatic sell-off in March, the share price fell from about 90 Rand to less than 40 Rand, and we used that opportunity to almost double our active position in MTN. But just if one looks back over the last 5-6 years, this was a 200 Rand share back in early 2015. And a series of events have plagued MTN that had led to a loss of confidence and sort of market pessimism around their largest operation, which happens to be in Nigeria. In addition to the regulatory events that have faced MTN Nigeria, there's also been a sort of a devaluation of the Nigerian currency that has run in the background, that has meant that the translation of their Nigerian profits into rands has been under pressure. But back in 2015, MTN ran into trouble with SIM registration. It was levied an enormous fine that has, it is subsequently settled in installments. And then in late 2018, there was a sort of an accusation of having not paid their taxes. Again, a threat of a fine that was eventually resolved. And then leading into March of last year, as with the rest of the market, there was a significant collapse that was prompted by sort of lockdown that led to a very weak oil price. Nigeria as an economy is highly dependent on oil for its export revenues, and there was significant fear around further devaluation of the Naira, and what appeared to us to be forced selling or capitulation from certain investors that created an opportunity for us to accumulate a significant portion of the business, such that Prudential became a top 3 shareholder during the course of last year. And what's pleasing is, that 94% sounds like, it is an exceptional return, but where the share price is today is still no better than where it was in 2016. So we bought in at an average purchase price of 40 Rand in March and April last year. And today, MTN is now 140 Rand share. But more importantly is we still believe that there is further upside. And so this is a sort of an update of the sum of the parts and the sort of add up of the values that we attribute to each of their different operations. And the red dotted line represents the current share price. And just again to highlight what gave us the comfort and the opportunity to build the position in March last year was that, you can see on screen that South Africa alone we think is worth roughly 50 Rand a share. And yet we were gifted the opportunity to accumulate shares at around 40 Rand. And so last year there were certainly parts of the MTN group that the market wasn't willing to attribute any value to. The main concern was that red block, the net debt in the group. It was higher this time last year, and one of the concerns the market had was that some of that, more than half that debt, is actually dollar denominated, sitting at the center, and it needs to be serviced from upstreaming of or payment of dividends and upstreaming of cash flow from the underlying African opportunity operations. So with the oil price collapsing, their largest operation being Nigeria, there was this inability to upstream dividends that led to the market panicking about whether that debt could be serviced. What gave us comfort to accumulate our position was the fact that South Africa alone, in our analysis, was able to service their debt obligations on the assumption that they would suspend the dividend. But last, just to close off on MTN, it's just, we still think that this is a very conservative add up. So we still see, as shown, that we think the share is worth at least 160 Rand plus. And what this approach doesn't attribute a value to separately is their mobile money business. So MTN is known as a mobile telecommunications company, but increasingly it's got a fast-growing mobile money operation that we think is deserving of a higher multiple than what one would typically attribute to their mobile operations that are more mature. And in this approach, we're simply using a sort of a historic mobile valuation multiple to value each of those operations. And so this, as I said, is conservative, and we remain overweight because we actually think that this there's an opportunity for a scope for significant further re-rating of MTN.
Thanks, Chris. Quite an interesting investment case there. I do maybe want to turn to the resources sector. It's one that's obviously quite topical, particularly in the South African environment, and it's the sector that seems to bail us out when we need it the most. You've got a few overweights in your portfolio to a couple of resource stocks. But if we look back to your previous webinar, you were approaching the sector with some caution. And we've seen some sharp moves in commodity prices. How are you approaching the sector given the big moves we've seen in the likes of iron ore and the PGMs?
Yeah, so this again is a slide that was taken from the March webinar, in which we just highlighted the very sharp underlying moves in two key commodities for South African mining producers. On the left is iron ore, and on the right is rhodium. Rhodium is a metal that is extracted from our platinum mines and is in relatively small proportions. But one can see here that there'd been a dramatic rally in the price for rhodium from sort of $5,000 an ounce to almost, in March of this year, to $25,000 an ounce. And what, this for us was making the call as to how much to allocate to resources and, the selection of which resource shares to own, very tricky. These underlying commodity prices were well above their sort of cost of production. And so from our perspective, the respective miners were over-earning or enjoying very elevated profit margins. And so it led to us being more cautious than what we could see some of our competitors in terms of their positioning. Iron ore was being driven primarily by Chinese steel production that in turn was being driven by large investment into infrastructure, and rhodium was disrupted. Had mining production in South Africa disrupted by lockdown, and the demand is primarily goes into auto catalysts that are needed to meet emissions control from internal combustion engine vehicles. And so it's worth just highlighting what's happened subsequent to that those March prices. And here one can see this dramatic correction in both iron ore and rhodium, where the underlying commodity price has almost halved in both cases. So iron ore today is sort of around $115 an ounce, dollars per ton, and rhodium is below 15,000. And so it was very, the concern we had was that while those prices prevailed, the spot prices, they were making exceptional profits. it's very difficult for share prices to appreciate if you've got their primary driver of revenue falling as it has done this past 6 months. And so our approach to the sector has been to try and look for alternative exposure, and if anything, to try and avoid this iron ore and PGM risk. And so example of that in the portfolio was we brought Glencore in as an interesting idea towards the end of November in 2020, and just showing the respective share price of Glencore and Billiton on screen. But more importantly is if we look on the right-hand side, is just those two pie charts represent the contribution by metal to each group's profits. And so most noticeable is in the bottom pie chart, that pink contribution from iron ore for Billiton, where iron ore accounted for almost 70% of the group's profits. Whereas in contrast, Glencore, you'll see, has no, essentially has no reliance on either iron ore or PGMs. And that, given our concern of, around the prevailing levels of those two commodities, and taking valuation into consideration at the same time, prompted us to start accumulating and building a position in Glencore across the Prudential portfolios. So if one scrolls forward and looks at how those two prices have performed subsequent to that November decision, we can see that Glencore has significantly outperformed the alternative on screen being Billiton as a result of that correction or pullback in the underlying commodity price to which Billiton is dependent. And again, this is short periods of time, but very dramatic sort of differential in price performance.
Thanks, Chris. That's, I think, a good example of active stock picking within one particular sector in resources, using your example. I do want to go back to some of the contributors to your outperformance. What I did pick up when I looked through the list of stocks is that a number of the stocks that added value in your portfolio, in fact, came from stocks outside of the top 40, so smaller and mid-cap stocks. A few of them that I picked up were Impact, Altron, and Textainer. How much of your portfolio is invested in these ideas? And given the quantum of assets that you manage at Prudential, are you able to consistently add value through the smaller names on the JSE?
Yeah, no, well picked up, Rochelle, and thanks for raising the point, because we often have this misperception that because of our size, or the fact that Prudential is a large manager with a large asset under management base, that we unable to invest outside of the sort of top 40 shares. But as we can see on the right-hand side of the slide on screen, yes, our market is concentrated, and yes, the portfolio does have sort of just over 70% invested in large caps, keeping in mind, Naspers and Process account for almost 15% of that 72. And to put that in context, the CapSwix index, or if one measures them, our market as represented by CapSwix, it has just over 80% in large caps. So we're actually, underweight large caps. And the Prudential Equity Fund, as you can see, has got, almost 30% of the portfolio invested in small and mid caps, with a larger contribution, or proportion of the fund invested in those small cap ideas that are spread across a number of names. But more pleasing is if one looks on the left-hand side, and again, this is a sort of a breakdown of the contribution by on a size basis to the relative returns on a 12-month rolling basis. And again, if one just looks at this last 12 months from September 2020 to September 2021, you've had almost equal contribution, almost a third, a third, a third, coming from each of those size buckets. And most pleasing is that, you know, you've picked up on, for example, the Textainas and Impact, PPC, you know, have, so 2/3 of the alpha was actually generated from outside of the large cap holdings of the portfolio. And that has been a feature of our market this past year. And I think it, you know, it does, you know, sort of put to bed the idea that, you know, Prudential is unable to invest outside of large caps.
Yeah. What's even more interesting for me on this chart, Chris, is that you know, 2/3 of your relative outperformance has been delivered by almost 30% of your portfolio. So I guess that talks to the conviction you had in those smaller and mid-cap ideas. Can you maybe give us an example of a mid-cap idea that's contributed some value to the portfolio over the last 12 months?
Yeah, so I mean, we did show it on the top 12 active positions. Textaina is a company, you know, held across, you know, majority of the portfolios at Prudential. In aggregate, Prudential owns almost at our internal limit of 15% of the company. It is a sort of a meaningful holding in the Prudential Equity Fund. You know, it represents, you know, almost 4% of the SA equity portion of the fund. And the reason we like this company, and we've held it for some time, it has to be acknowledged, it's done particularly well this past year and a half. But the chart on screen is an index of container throughput. So it's an aggregation of global container moving through ports around the world. And one, you know, the key takeaway is that it is an upward sloping series, and that there is this underlying global demand for movement of goods, you know, in containers. So shipping of goods around the world typically is done, you know, in steel containers. And Textaina, that's its primary business. It is the world's second largest leaser of shipping containers. And it's this underlying demand for containers that, you know, drives its revenues. What one can observe on the chart is that, you know, as with a number of you know, stocks and industries, there was a slowdown. They were impacted by the sort of rolling lockdowns that took place during the course of 2020 in response to COVID. And you know, again, that impacted the share price, and it's largely this recovery from that, you know, sort of depressed valuation level that has contributed, you know, to Textaina being the second largest contributor to performance this past year. But what is pleasing is that where container levels are today is they're well above pre-COVID levels. So that's not true of some sectors in the SA market, like hospitality, for example. But what prompted us, you know, if one moves to Textaina specifically and looks at the valuation on screen, is the black line represents the, you know, price to book ratio for the company. If one looks in March of last year, you were being offered this exceptional entry point, in that the large portion of the book value is effectively steel, tangible steel containers, and you were buying those at a almost 70% discount to their carrying value. As you can see on screen, the black line has gone from 0.3 times price to book to almost 1.2 times. So that's a fourfold increase in price. And while it's almost back to that pink line that represents the average over this time series, the green shaded area in the backdrop represents the annualized return on equity. And so again, Textaina had, you know, one of the contributing factors to that depressed valuation was that it wasn't generating the required returns from the equity in the business. This in part was, it had suffered a setback in the 2016-2017 period when one of its customers essentially went into bankruptcy. And then we had a number of, they'd acquired, they'd continued to grow their fleet and had acquired some containers that were essentially struck at a depressed lease rate. But given the strong demand we've seen as global businesses try to rebuild supply chains over the course of this year, we've seen utilization of the container fleet at record levels, and we've also seen a strong upward move in lease rates. And so we've already had 2 quarters of financial results for Textainer this year, and if we annualize the run rate, the returns they're generating are represented by the red star on screen. And in actual fact, this year we're going to see an annualized return of almost 18% that is actually above management's own sort of targeted long-run returns of between 10 and 15%. But it's for this, there's some very favorable tailwinds. They continue to add new containers to the fleet, and given the very strong demand environment we find ourselves in, these containers are being leased out for almost the full duration of their life. And as a result, the term of lease for the entire fleet has nearly doubled from 3 years to 6 years, such that it gives us greater certainty that these improved returns will be with us for longer, and therefore it remains a core holding in the portfolio.
Thanks, Chris. I do want to turn to another sector, the SA listed property sector. It's been largely unloved by the market. It's been up substantially over the past year, but over the past 3 years, it still continues to struggle in terms of performance. It is part of your investable universe. At the previous webinar, you talked through Growth Point. How are you approaching the sector, and have you made any changes to the individual stocks that you hold?
Yeah, thanks, Rachel. So the Prudential Equity Fund does actually has maintained some exposure to SA property, listed property. We no longer own the Growth Point. We did buy it in March, April last year, but I think we've collected 2 dividends along the way. We bought in at an average price of 12 Rand and have exited at close to 15 Rand. And so the only remaining property exposure that the fund does have today is SA Corporate, which, just by way of, got on screen some comparisons of the SA Corporate property portfolio to that of the listed property index. And what stood out for us, or one of the reasons we like SA Corporate, was, aside from the valuation on the left, which you can see has significantly derated, providing a very attractive entry in our opinion, but it's more the differentiated exposure of its property portfolio to that of the All Property Index, and in particular office, so the green shaded block. SA Corporate has a relatively low exposure, or smaller exposure, to office than the average property stock on the JSE. And this is a sector, I think, that is probably the most challenged within property, particularly as we grow accustomed to a hybrid work from home environment. We're seeing rising vacancies in the office segment, and having, landlords are having to discount or have negative reversions in rental, particularly for office. And so SA Corporate was, it's that differentiated property portfolio, coupled with, on the left, you'll see, again, last year, one was able to, buy SA Corporate at a 75% discount to the carrying value of its properties. And yes, we can debate whether those values, those valuations were perhaps overstated, but we felt that there was more than enough margin of safety. And so, I think the chart doesn't do justice to what the price has done, but it is effectively doubled. So you've kind of seen a doubling in the share price, and yet it still trades at 50% discount to carrying value. What gives us some comfort has been the fact that they have been able to dispose of certain of their properties that were deemed non-core in order to strengthen the balance sheet, and those disposals have been done at around 5% discount to carrying value, nothing close to or nothing like the sort of quantum of discount that we've seen the market attribute to the share.
Thanks, Chris. I do definitely see a theme of valuation coming through in your presentation, and also the willingness to stock pick and be active in some of these names within sectors. You've given us a very good sense of where some of your stock picks lie within the fund that you manage. Ultimately your job is to beat your benchmark. However, understandably, some clients may be approaching the equity market with some caution. There's talk of inflation, rates going up in global markets, as well as the SA economic backdrop. Can you maybe give the audience a sense of the value of the market as a whole, and sort of the prospective returns that may come from that going forward?
Yeah, so understandably, the market's had this very strong rally, and so there's perhaps some skepticism as to what prospective returns are still on offer. What we're trying to illustrate on this chart is you as an investor can invest across a variety of asset classes, both domestic and foreign, and the dots on screen represent our estimate of fair value for a given asset, i.e. that's the yield that we expect to receive for the associated risk of that asset class. The columns or the bars represent the current yield on offer. So in the case of SA equity on the far right, the earnings yield that is shown on screen is the inverse of the price earnings ratio. And so when that column is above that green dot, it means that there's an excess return available to you as an investor today, and that we're seeing very attractive. We still feel that despite the strong rally in SA equities, that there are above average returns available to us that keep us invested, and that's true of other equities elsewhere except for the US. And one needs to note that the US accounts for over 50% of the all-country world index or global equities. More than 50% of the market capitalization is associated with America. And there we think valuations are a little bit full. But in contrast, so risk assets on the right, equities, offer significantly better real return than what is on offer from investing in so-called less risky bonds and cash. If you were to park your money in cash today, you're actually going to lose money in real terms, i.e. the return you'll receive will be eroded by inflation. That's not true of SA bonds. So we still think as SA investors, there are very attractive returns to be had in owning South African government bonds. And as an equity investor myself, the Prudential Equity Fund, we remain overweight domestic equities in preference to taking money offshore.
Thanks, Chris. That looks like quite an attractive real return from the SA equity market. Of course, given your 20-year track record, in excess of 20-year track record, we would expect you to deliver a return that's higher than that of the market.
Well, correct. That's the beta on offer based on our assessment of current pricing. So as seen on the chart, it's just over 10%.
Yeah.
So in other words, the forward multiple on the market is a roughly a 10 PE. The dot is a sort of an 8% yield, representing what we think is a fair multiple for the market of 12.5 times.
I think the natural question is then how are we going to get there? What are your top stock picks going forward?
So we'll revisit this slide. So these are, as we stand today, the 12 largest active positions in the portfolio, and it might perhaps surprise the audience, given some of the returns that have already been realized from some of these names, that there's very few changes between now and March of last year. In fact, there are only 2 changes to the 12 most active stocks. Foschini has replaced Truworths, and Glencore has replaced Exxaro. Admittedly, the weights associated with each of these stocks is slightly different to where it was in March, but these 10 stocks, all are held in a position of greater than 2% actives. In many cases, some of them are 3% or more, but these represent our best ideas.
Sure. Thanks, Chris. Do you maybe want to close us off by showing how your performance has fared through time? It's easy to look at a point-to-point performance metric, but you have been fairly consistent in delivering this through time.
Sure. Thanks, Rochelle. So as we've tried to hopefully communicate today, a process remains unchanged, and we think it's tried and tested. We don't necessarily strive to be the #1 fund in any given measurement period over 1 year, but what we have found is that by consistently delivering that top quartile performance year by year, we get this compounding effect that has meant that the fund has achieved its long-term track record is something we're very proud of. And what we're showing on screen here is the Prudential Equities 10-year rolling active returns. And so there's 20 years of history that effectively sit behind the chart. The black line is that of the 25th percentile fund. And so even though from time to time Prudential Equity Fund might have a bad year, what one has seen is that despite those poor years, over the long run, the fund has maintained its objective of delivering top quartile performance, and in actual fact has exceeded its objective of 2 to 3% outperformance on a rolling 3-year basis. And it's about time and patience and believing in the Prudential team's ability to stock pick, that we remain confident in our ability to continue to deliver this level of outperformance.
Great. Thank you, Chris. And it was great talking with you today. I think we do have some time to answer some of the Q&A that's come through this morning.
Thanks, Rochelle.
Thanks. Okay, Chris, the first question we have is from Mike Chung, and he would like you to share your opinion on the coal market in general, and also provide a comment on the energy market.
Yeah, thanks for the question, Rochelle. The Prudential Equity Fund does have exposure to coal. As discussed in the webinar, we talked about the Glencore exposure. But in addition, we do still retain a position in Exxaro. And the thinking behind that investment is that while Exxaro derives the majority of its market value from its investment in the Sishen Iron Ore Company, it owns the largest coal mine in the Southern Hemisphere, Grootegeluk. South Africa is coal rich. And as we know, we've only just completed the construction of 2 brand new coal-fired power stations, Medupi and Kusile. And Exxaro's coal mine has got a tied supply agreement to the Medupi power station. That coal mine has very long life reserves, probably in excess of 40 years. And it has a sort of the mine is literally built right next door to the new power station. So more than almost half of Exxaro's earnings currently are derived from coal, and yet the market is only paying or attributing value to its investment in the iron ore asset. So there is this sort of risk, or coal being out of favor, and for us that creates the opportunity to actually own these coal assets, because the market is attributing such a low value to coal, both in South Africa and globally. So our view is that, given that South Africa has extensive coal reserves, and for some time the power stations are going to be dependent on coal, that gives us comfort that, or willingness to own these assets in the portfolio.
Thanks, Chris. The next question we had was from Glenn, and it was on financials. So we didn't cover financials in the formal part of the presentation. And of course, the sector is made up of banks, insurers, and the asset managers. How are you positioned within the general financial sector?
Thanks. So as we showed on I think it was the top 12 actors, we do have exposure to banks, and we are overweight the bank sector, with a preference for Standard Bank, ABSA, and Investec. Outside of banks, we no longer have any exposure to life insurers, having previously owned Old Mutual. And instead, we've chosen to position ourselves in an alternative asset among the alternative asset gatherers, being the asset managers. Obviously, as an asset manager ourselves, we understand this business, and the fund holds shares in both 91 as well as Coronation. These businesses are highly cash generative and offer what we believe is a very attractive dividend yield, but their revenues or income is essentially derived from the underlying assets into which they're invested. So it's almost like buying a balanced portfolio that will earn a return from the underlying assets, and they don't require capital in order to grow, and therefore are able to return or have a very high payout ratio. So that's largely how we've positioned the portfolio, is to be overweight SA domestic banks and overweight the two asset managers at the expense of not owning the life insurers.
Great. Thanks, Chris. Maybe going back to the theme on resources, we had a question come through from Adelaide. You indicated that Northam is one of your top overweights. How is that a top overweight, as the question reads from Adelaide, given your concern around the PGM prices? Or has that been priced into the market already?
Yeah, so it ties back into the comment made around our philosophy and process, and wanting to build or stock pick within sectors. So in terms of our exposure to platinum in the portfolio, platinum producers relative to the sort of benchmark, we are in fact underweight. So we do have concern about the metals, but at all times we recognize that we don't know where these metal prices or for how long they remain high, and that we want to maintain some exposure. So our preferred, or Northam is our preferred exposure within the platinum sector. And the reason we like Northam is it's one of the few platinum mines that has, over the last 5 years, chosen to invest counter-cyclically. So when the PGM basket price was at all-time lows, it had gone and raised capital and invested in the construction of a new mine. And that mine is now coming on stream or ramping up its production, such that in driving its revenue, you've got volume. So there are more saleable ounces of platinum, palladium, and rhodium that will, in our view, mitigate against a weakening pricing environment. So it is, in addition to the Northam, we own some Amplats in the portfolio, but we no longer hold the alternative of Impala or Sibanye.
Great, thanks, Chris. I see we have about 3 minutes left. So maybe just a final question. we didn't really touch on your offshore exposure within the fund. Your fund is mandated to invest up to 30% offshore and 5% in Africa. At the previous webinar, you talked about cutting your offshore exposure back as the rand weakened. Where are you sitting at the moment in terms of offshore exposure, given where the rand is trading as well?
Yeah, so currently the fund has in aggregate 12% held offshore, with the balance invested in the South African equities. Of the 12%, roughly 1.5% is held in the Prudential Africa Unit Trust. And the balance, the 10.5%, is invested in the Prudential Global Equity Fund that is managed by our former CIO, Mark Beckenstrater, in London by M&G. And the reason, so it's quite, we remain well below our maximum allowable 30% offshore allocation. And that ties back to the valuation slide we showed in the webinar, in that we do recognize South Africa only represents about less than 1% of the global equities. But the valuation signal for us still present, we're still seeing lots of opportunities to put money to work that offer better prospective returns, in our opinion, than that is available on offer from owning global equities. So that view, in part, reflects our view on the currency. So the South African exchange rate, the rand, we think the rand is well supported currently, given the backdrop from the commodity prices. And so we are seeing, as a country, exports enjoying very favorable, these very favorable commodity prices, such that we're running with a record surplus in terms of our current account currently.
Great, thanks, Chris. That's all we have time for today. Huge thanks to you for your insights today and for the presentation and discussion. And once again, thank you to the audience for giving us your time today. Keep well.